the sequence of priorities, we have now put inflation before growth. We have said with regard to liquidity, the liquidity withdrawal will be done in a multi-year time frame. The situation is dynamic and fast changing, and all our actions will be tailored accordingly. Thank you.
It is undoubtedly a policy where the Reserve Bank has transitioned from dovish to hawkish. For the record, it has left repo and reverse repo rates unchanged. Its stance remains at accommodative, but that doesn't mean it has not become hawkish. Firstly, look at the inflation forecast. It's been raised sharply to 5.7%, and it's important they have assumed crude at $100 per barrel, because in the market, economists who have assumed crude at $100 actually have a CPI forecast of 6% for full year. Now, the bigger hawkish surprise is the Q1 forecast. April-June has been put at 6.3. Most economists on the street estimate Q1 at less than 6% because Q1 of 2021 had a high base. Clearly, Reserve Bank is expecting a very sharp month-on-month jump in March, April, and that's why such a high Q1 number. Market anticipates that Reserve Bank is standing ready to increase the CPI forecast closer to 6, depending, of course, on how crude moves and data comes in. Also, the stance, while it is accommodative, has been reworded to focus on withdrawal of accommodation. Wording, again, as the governor pointed out, the stance, now the word inflation control figures before support to growth. Also, RBI has instituted a new facility called Standing Deposit Facility, where it will absorb all the excess liquidity without collateral at 3.75%. So now the yield curve starts at 3.75. That is the least. And then rises. Finally, Reserve Bank says it is committed to withdrawing liquidity starting from this year, which indicates that maybe it will not do that much of open market purchases of bonds, and that explains why. The 10-year bond yield ended at 7.12, a jump of over 20 basis points in just one day. Okay, joining us now to take the discussion forward and understand the policy better are Abhik Barua, the Chief Economist at HDFC Bank, Neeraj Gambhir, Head of Treasury Markets, Axis Bank, B. Prasanna, Head of Global Markets Group at ICICI Bank, Rajni Thakur, Chief Economist, RBL, and Ashwini Bhatia, Managing Director at SBI. Gentlemen and lady, thank you very much indeed for joining us. Abhik, now what is the reading? Do you think they are going to turn neutral very quickly?
I wish I sort of could understand what the phrase focus on the withdrawal of accommodation meant. I guess it indicates that they would move to neutral sometime soon, and perhaps hike rates simultaneously, or with a gap of one meeting start hiking rates, because I think given the inflationary situation and the likely persistence, rate hikes in terms of the repo rate hike are perhaps due. So I think that is what I would expect, that there would be a change in stance, either accompanied by a repo rate increase or
in the next policy itself.
Repo rate increase.
In the next policy itself, in June itself.
Yeah, well, I would think so. It's about time that we sort of started doing things on the ground rather than just focusing on something.
Oh, right. Fair enough. Let me get to the money managers in that case. Prasanna, what's your sense? Are you now focused on a rate hike very quickly, June or August? And therefore, how will yields move, you think?
Alluding to. So while technically they have kept the accommodative stance unchanged, they have given clear indications that there is a change in terms of focusing on withdrawal of accommodation, giving inflation higher priority, and even completely, dropping the reference to the COVID-19 impact. So overall, I thought it was a good job of communication, but where they actually surprised the market was in terms of even faster action. And markets was expecting the first rate normalization to happen in June, and now we have done it. They have done it today itself. So to that extent, I think there are enough things in the policy for us to believe that the normalization has actually started earlier than expected. And the SDF rate, like you said, Lata, in the introduction, has actually done that indirect 40 basis point rate hike at the short end of the curve today itself. So what it also means is that since the normalization is now possibly starting a couple of months earlier, and the fact that in the post-policy conference, the Deputy Governor did allude to real rates now is a process of getting the real rates back to zero territory. And if you have to read that along with the inflation expectations being in the region of 5 to 5.7, depending upon whether you look at a point-to-point estimate or a average estimate, it definitely means that you have to have expectation of maybe 75 to 100 basis points of rate hike for sure this year, if you even have to go to zero by end of the year, zero real rate by end of the year. So I think that's where the expectations are. Markets have really, in terms of what is being priced into the curve, if you look at the OIS market, yields have shot up substantially at the short end, clearly indicating that market is now expecting more rate hikes in this cycle than what earlier we were expecting.
Okay. Well, Ashwini Bhatia, whatever your ALCO says, for the banking sector as a whole, if inflation is being projected at 5.7 and 6.1 in the quarter that is underway, you have to raise deposit rates, right? I suppose even lending rates?
So sooner or later that will happen. I think in the last quarter of FY22, the bulk rates had already started moving up. So I think it's a matter of time before that happens. But as long as the liquidity is ample, I don't think the rates are going to move up very sharply. Coming to the policy action, I think the indications from the Reserve Bank in the last two meetings were very clear. The operating rate actually had moved to VRR. Given what has been happening on the geopolitical front this time, and with what was happening on food, fuel, commodities, I guess they only had to accelerate the action.
Yeah.
And the very fact that the Reserve Bank governor says that they are not hostage to any rule book very clearly states that the Reserve Bank of India is actually going to take all action required to ensure that inflation doesn't go out of control. That I think would be the main thing. On deposits, I think something may happen, but right now with the overhang of liquidity, let's see how fast the liquidity is removed. And if the governor is saying that it's going to be a multi-year process, let's see how fast it happens. I mean, you're going to see some swaps coming in the next couple of months. That will withdraw some liquidity. You're also going to see reduced OMOs. Let's see what the borrowing program, what happens to the borrowing program. And every week, if they're going to raise about 33,000 crores, let's see what happens there also.
Okay, well, Neeraj, I'll just come back to you in a minute, Mr. Bhatia. Let me let Neeraj have his say. Neeraj, it doesn't look like there will be too many OMOs. If you are going to say that starting this year, we are going to reduce liquidity over a multi-year period. So lower OMOs, what is your sense in terms of bond yields then? And are you reading it as lower OMOs?
So I think the liquidity formation process in India is a combination of multiple things, not just the RBI's balance sheet expansion through OMOs. There is also the intervention aspect which needs to be taken into consideration. All this while, Reserve Bank was actually intervening to absorb dollars, and hence it was releasing rupee liquidity. Off late, with the outflows, we've seen that the intervention has swung on the other side, which means they have been supplying dollars to the market, and that reduces the liquidity from the system. So if we have a Reserve Bank of India intervening to sell dollars, and we have withdrawal of currency from the system, you could still have a situation where RBI is doing some limited amount of OMOs to support the government borrowing program, and yet the liquidity in the system continues to steadily come down. So I think that's the situation that I'm looking at. It'll be a slow process, which means that while they are doing some bit of OMOs to make sure that the government bond yields are well managed and the government borrowing program is handled effectively, the net liquidity in the system continues to be on a very smooth glide path of reduction.
Okay. I'll
As
come
far as
back
the
to-
bond yields are
Yeah.
concerned, I
Yeah.
think we've seen a approximately 20 basis point reaction from the market today in the government bond market. I think we will continue to see as the supply continues to be there in the market. Even if, I expect the Reserve Bank to, do some bit of volatility management and making sure that the market action doesn't become, very volatile. I do expect the yields to continue to inch up.
Okay. Rajni, the big shock for me was Q1, they have forecast 6.3 and Q2 5.8. In the poll that I got, it was ulta. So they are expecting a very big jump. I got a poll of 5.8, I think, for Q1. They're saying 6.3. Do you think this is one foot forward to increase the full year inflation forecast later on?
So, yes, we were also at 5.8 for Q1, and then Q2 and Q3 seem to be, little less than what we expect. So for Q2 and Q3, for example, we are at 6.2, 5.9, and they are at 5.8, 5.4. I think there's, to kind of step back and look at the whole picture, there's lots of moving parts at this point of time for inflation, for growth, and for financing conditions as well, given the global uncertainties. What has probably triggered a more aggressive reaction in terms of move towards a pre-pandemic normalization is the current geopolitical situation. And, if you remember in February, the market was sitting ready for an indication or a move towards normalization, and RBI surprised by sitting tight and focusing on the signaling effect. This time they have used this space to catch up on, pivot towards normalization, so to say. So putting inflation before growth, narrow corridor, policy corridor,
so
and
is
then
6% coming, you think?
Withdrawal. Yeah, but a $100 oil price assumption at this point of time is what I would debate in terms of their projections. Most likely, the average for the year is an 80 is as likely as 130 for oil price at this point of time, but the base case probably will not stay at $100.
Okay.
What they have used is a current pump price as their base projection, and they've done a 120 basis point upward revision in inflation and 60 basis point downward revision in growth. So there is a sense that growth uncertainties do remain. If you looked at particularly for H2, for example, we are on a 4% handle growth. For a growth at 4% handle, aggressive rate hike that market is expecting doesn't look very likely.
Okay.
We could likely see short-term aggressiveness in terms of policy normalization, and by the time we hit the second year, both inflation should ease off, and also growth factors would probably put growth ahead, growth worries would put growth ahead in terms of RBI focus.
Fair enough.
Then inflation worries.
Fair enough. Actually, that's the expectation even in the US, that perhaps as time goes by, the inflation numbers will smooth out and they may not have to be that hawkish, with the Reserve Bank turning distinctly hawkish. The forecast is 5.7 for the full year. As it is, Jan, Feb, March is going to be above 6%. Their forecast for April, May, June is 6.3%, and for July, August, September, 5.8. If that goes to 6, the MPC's mandate would be breached. Their mandate is 3 quarters in a row can't go above 6. They have to instantly take action. Abhik Barua, will that happen?
There are two options really. One is to sort of go the way of the Fed, move away from sort of a reasonably calibrated glide path to sort of almost manic paranoia, and start hiking rates very aggressively. The other is to sort of explain it in terms of there still being sort of extant supply side problems that are keeping inflation elevated, and just stick to this policy of calibrated normalization. Which of these two strategies will they choose? I think given the exceptional circumstances that we find ourselves in, I don't think the MPC will get too much flack, even if they were to remain somewhat calm, despite inflation breaching the tolerance level. And I think that's the way it'll go. in the past, the RBI has also made it very clear that there are lagged effects. I mean, rate changes have lagged effects. They'll perhaps talk about the fact that if they do front load some of the hikes and normalizations I anticipate they will, then they will say that just, hang on for a bit. Okay. There are these supply problems that are still
I'm a little unsure. I'm a little unsure, Abik. The law is very clear that if you go 3 quarters in a row up above 6%, you have to write a letter to Parliament explaining why you failed. And they have to hike rates. The law is very clear. So, I mean, I don't know, maybe it will not come to it. It's quite possible, as Rajni says, that crude will not be at 100 and the 3 quarters in a row doesn't happen. But that danger, according to me, lingers. Let me get back to the market. We didn't discuss rupee. Prasanna, what's your sense? Rupee was admirably stable. So is that a way of the rupee recognizing that behind the curve RBI has now come back in line?
Yeah, so very quickly before that, Lata, on your point on 3 quarters, I frankly think that RBI is going to possibly act on the repo either in the June policy or the August policy. So I think they would have some action that they have already taken by the time it reaches, even if it does reach above 6% for 3 quarters. So I see that just as a technicality, and I think RBI is anyway pretty clear in terms of what they are doing in terms of targeting inflation. And your question on the rupee dollar, I think you're bang on. Though I don't want to use the word behind the curve, I do think that there are some sections of the global investors who really did possibly think that RBI was at possible risk of being behind the curve if they didn't do enough today. And I think that has given them the confidence possibly today that RBI is a renewed focus on inflation is, I think, something that is quite positive. But at the same time, I think you should also remember that the dollar strength, which is happening against all the other currencies globally, Lata, is possibly going to continue in the next 3 months with the Fed continuously speaking with a lot of bearishness. The peak rate, like we discussed earlier, is higher than the neutral rate as determined by the Fed governor's median expectations. So all of that plus the Q1 being a lean season typically for INR basically means that while it is positive today, I think we have to prepare for some kind of a gradual depreciation over the next 3 to 4 months. Having said that, the equity market outlook and the IPO flows, if it were to come in over the next 1.5 months, will again be positive for the INR.
Absolutely. Well, I will be behind the curve if I didn't ask the two money men over here, how much will home loans rise? Ashwini Bhatia, you think the cheapest home loan is over and it can rise within this year, 2022?
I would think so. With the 10-year at 7.12, I don't think it is reasonable for all to expect a home loan at 6.4 or 6.5. So certainly, yes, some change could be coming there soon. But again, as I said, the MCLR move only happens after the change in the deposit rate. Right. So once that happens, then you generally move to the MCLR.
Okay. Yeah, fair point. Actually, Ashwini Bhatia can have a lot of money in his pocket. It's his SBI. Neeraj Gambhir, you think others will have to raise their deposit rates and their loan rates much faster? When do you expect the first rates to rise, both deposit and loans?
So on the deposit side, I think we've already seen in the last, end of the last quarter, increase in the bulk deposit rates of about 25 to 30 basis points. We have seen an increase in the CD rates. So effectively, some part of the borrowing of the banking system has seen an increase. I think it will continue. I think we will see some more wider increase in the deposit rates, both in retail as well as in the wholesale side, as the monetary policy continues to normalize. And as the deposit rates normalize, both on the MCLR as well as the other lending rates, we could see some upward bias. I think particularly I'm looking at the rates at which the banks are lending to large corporates. I think those rates have been quite sticky of late, and they've been quite low. So I think we could see some upward movement there as well. A lot of home loans and a lot of retail lending is linked to EBLR, which is the external benchmark rate, which is repo. So as the repo rate increases, we will see obviously the existing home loans and some of the other retail assets starting to get repriced. So as the monetary policy normalizes, obviously both the deposit side as well as the lending side of the banking system will see a reprice as well.
Okay. Well, I'm sorry I'm out of time. So I'm going to ask you all a few questions which have to have monosyllabic answers. And it should be a number. Okay, Rajini Thakur, how many rate hikes in FY23? 2. Abik Barua, how many rate hikes in FY23?
3.
Okay. Ashwini Bhatia, what will be the amount of increase in deposit and lending rates? 25 basis, 30 basis, 50 basis, FY23?
25 to 50.
Okay. Prasanna, end rate of 10-year bond in 2022?
End rate? 7/4 to
10-year bond. 10-year bond.
7/4 to 7.5.
Oh, that's it. Neeraj Gambhir, actually same question to you. Where may the 10-year bond end?
I think we are at 7/4 to 7.5 for now.
Okay. So 10-year doesn't rise much, but the cost of money is likely to rise for retailers, especially if it is at least 2 repo rates, then 50 basis EBLR, because all rates are benchmarked to the repo. Home loan rates are likely by the end of this year to be higher by 50 basis points at least. So all of you who are watching, if you have any deposits to keep them right now, wait to keep them, you will get a better rate. And if you're taking a home loan, take it now. That's the message from our money men and our economists who have joined us. Thank you very much for joining us on this special broadcast on the monetary policy.